Okay, what about adjustment accounting is deferrals. Unlike the accruals, deferrals is totally opposite. For example, prepaid expense, that is the expense paid in advance before the recognition. The company can pay the expense in cash first before using the services. For example, prepaid rent expenses or prepaid insurance expenses. But until the company receives the service, now it should be recorded as an asset. Why? Because the company has a right to receive the service or to use some services. And then the other cases is unearned revenue opposite of the prepaid expense. Unearned revenue is a receipt of cash in advance before delivering the service. So it is a liability account because it has an obligation to provide a service or product, but the company receives the cash first. So until the delivery of the service, unearned revenue should be recorded under liability. For example, the unearned rent revenue if the company is a landlord, or the unearned insurance revenue. So unearned revenue or unearned insurance revenue until the landlord provide the rent for the period. And okay, it should be, just give a second, it should be rent revenue. Okay, then let's practice for this exercise. Okay, this company now paid cash in advance to receive this auto insurance policy for 6 months, but it paid the $600 cash in advance. So let's record the cash on the credit side. How much is that? 600. And then, right, this is prepaid expense. It's not at the accrual base, it is a deferred transactions. This prepaid expense is recorded on the debit side because it's asset. Again, this prepaid expense is not the expense account, it's an asset account to receive the service. Until they receive the service, the company should record an asset. Once the company receives the service, now it turns to the expense, and then this asset is gone. Okay, so 600. Okay, like this, 1 month later, record auto insurance expense $100 because this 600 prepaid expense, prepaid insurance is now provided by 1 month's service. So let's remove this prepaid expense by 100 for the insurance service used for July. When they recognize expense, right, when the company use the service, when the company use the facilities or the product, now it should be recognized as expense. So insurance expense, finally it should be recorded by 100. 1 month later, the same way, 100. Prepaid expense reduced by also 100 because now this company used the insurance policy for August. The expense amount of 100 out of 600. Now, another revenue recognition. This company provide, the smartphone company provide insurance service by receiving $600 for 6 months coverage. So the company received this $600, but it's not revenue. It's not revenue at all. Why? Because the company hasn't delivered the service yet. So it is unearned yet. In order to be recognized as the revenue, earned and recognized or recognizable. Remember, on the revenue recognition policy, the accounting. So it should be unearned revenue. Unearned revenue 600. Now 1 month passed, so the company now can recognize as a revenue. Why? because it delivered this insurance service for 1 month for July. So it should be recorded as the revenue. Revenue by 100 for July service. So once the company delivered this service, the unearned revenue, it is a liability account again. Why? Because it has an obligation to provide the service. But once the company provided service for 1 month, it should be reduced by 1 month's service. Now record the revenue and reduce this liability. The second month, or third month, or fourth month, for 6 months, every month, the same way adjustment accounting with the recognition of the revenue for 1 month service. So that's it. So we now post all this journal entry into the T account on the general ledger. So the cash balance on the debit side and the credit side, there we go. So the cash balance of the debit account, which is asset account, it should be 0. Then prepaid expense on the, again, prepaid expense is an asset account, not the expense account, until the company received the service. Now, until the service received, they should be recorded an asset. The right to receive the service. Okay, 600 prepaid. Do you have a prepaid expense on the debit? No. Now, but we reduced this prepaid expense of the asset account on the credit because the company received insurance service for 2 months. Now, let's get the balance of prepaid expense. Prepaid expense, now the balance, which is the asset, 400. The right to receive the service for the rest of 4 months. And then unearned revenue, 600 of the liability is reduced by 100 because the company provided service. So 600 minus, now it should be reduced. Then finally the revenue, 100 revenue by the amount of the service for 2 months. And then the revenue, the total revenue recognized is 200. And the expense, now the expense, insurance expense, there we go. Insurance expense, by the 2 months, the company used this auto insurance policy. So 200 on the debit side of the debit side of the equity. So let's make sure that if we post all the journal entry into the T account. So cash 600 and 600, then prepaid 600 and 100. Then unearned revenue, and the revenue on the credit only 100, and then 100. Then how about the expense? Okay, we have an expense 100. So 1600 on the debit total sum and the credit total sum. The 1600 are balanced out. So we made sure that we collect all the journal entry into T account. Now let's put the balance of the balance sheet account on the balance sheet. Here, prepaid expense, the balance is 400, and the unearned revenue 400. Do you have other account? No. Okay, so say the revenue is 200, and then expense. What expense? Okay, the expense is insurance expense is part of the operating expense. So minus, we have to put always minus on the income statement when you post this expense. We don't have any other the gross profit 200. The operating income is calculated 0. We don't have any other revenue or gain or expenses or losses, so it's 0. Also, net income is 0. So the retained earning accumulated from the net income is 0. So the 400 asset is equal to liabilities and equities. Then we built this financial statement, balance sheet, and income statement. Okay, so we've done all the adjustment accounting practice for the accrual and depreciation and deferral cases. Okay, see you in the next video clip. Bye bye.